Many of you follow me on YouTube because I discuss stocks that most people don't really talk about. A lot of small caps, micro cap stocks, we talked about them before, CSV, GEO, and plenty of other ones, and they've been pretty good, big success on YouTube. And many of you keep asking me to talk about more and more under the radar, small cap, micro cap stocks, not just talk about stocks like Google and Apple and Amazon and Nvidia. Well, in this video, I have a massive surprise for you. I'm finally going to disclose another micro cap stock that I have very high conviction in, and I never talked about it on YouTube. These things, as you could see, it makes me pretty excited. I just love these stocks that most people don't know, and I'm the only one that's either buying it or that knows something about it. And I'm gonna share it with you on YouTube, and it's gonna be pretty amazing. And it's good for dividend investors, and it's also good for non-dividend investors. As the company is small, it has massive upside potential, and is growing free cash flow over 45% every single year. This is the perfect dividend stock or for non-dividend investors too. So if you do enjoy this kind of videos, please support me. Please press the like button or the dislike button. Leave a nice comment or a bad comment, whatever you think of the video. Just let me know down in the comments below. But I'm gonna start first with a one pretty large, mega cap, boring dividend stock that most of you know, and I think it's trading at a fair value in this overvalued market. And then I'm gonna get into the exciting micro cap, but it's gonna be very quick. Now, the first one, which most of you know, is Pepsi stock. I talked about Coca-Cola before. Coca-Cola has been playing out a little bit lately. Pepsi has also rebounded, but I still believe Pepsi is trading at a fair value kind of number. It's not the most undervalued stock in the world. It's hard to find undervalued stocks whenever you have the S&P sitting at 47, pretty close to 4,800, and you have the massive overvaluations that we have in many of the mega cap stocks. So sometimes you might have to settle for something that's fairly valued. To me, Pepsi is not extremely undervalued, but Pepsi is fairly valued. Most of you are familiar with the company, that they don't only own Pepsi, they own Gatorade, they own a lot of different chips kind of names, Lipton tea and iced tea and all these things, and Doritos kind of brands. You know them. I mean, most of you are familiar with the company by now. A lot of popular dividend YouTubers talk about it. They own many more brands than just something like Pepsi. It's a darling for dividend investors. They've been paying a dividend for 51 years, growing at 7.7% CAGR every single year for 3 months since 2010. So this is pretty amazing for dividend investors, 51 years. So dividend is nothing too crazy. It's around 3%, but this is more of a safe dividend growth company. And it's the highest yield it has traded at since 2016. 2016 used to trade that much, even sometimes late in 2020. But 3% is not bad if the company is growing the dividend 7.5%. Now, if the company was growing it at 2% and it was only 3%, I would say this is a ripoff. But sometimes these dividend growth companies have lower yields to compensate for whatever they are trying to do. Now, in terms of the dividend, I think the dividend is a little bit risky for now, but it's getting a little bit safer. I'm going to tell you why. Now, if you look at the trend between the dividend paid and the free cash flow 6.3 billion in 2020. Now, and the dividend was 5.5 billion, so they had around 800 million of extra free cash flow. Now, in 2022, they struggled a little bit because free cash flow dropped to 5.6 billion, while the dividend paid were 6.1 billion. So this is more than 100% free cash flow payout ratio. But you don't want to be confused with that, because 2022, they had a lot of one-time expenses, a lot of things happened. 2023 was better so far, and it's not showing up on this graph, but 2023 is around 8.9 billion of free cash flow, and the common dividend pays are still around 6.1 billion. So I believe the dividend is safe for now, and they have like $2 billion of extra free cash flow to buy back stock, which they do a little bit of buybacks, or they can maybe do something else with the money or pay down debt or whatever. But I think the dividend is safe for now, and they will continue to grow it, I believe, around 7.5% every single year. In terms of a return, with something like Pepsi, I see two main ways you can make a return. The first one is with a slight multiple expansion, because now the multiple is sitting at 21 times earnings. 21 times earnings is not a bargain, but if it's one of the lowest since pretty much 2021, and it traded at the same multiple in 2019, this is when it was crashing in March 2020. But the 5-year average or mean multiple, whatever you want to call it, is pretty close to 24 times earnings, and now sitting at 21.5 times earnings. So I see a potential multiple expansion to the mean mean of 23.5 times, nothing too crazy. But the main return that you will experience is mainly through EPS growth. Pepsi and Coca-Cola, they have massive pricing powers. They can raise prices if volume is going lower, but they've been having a pretty good record over the last few years because prices have been going up and volume has also been going up to many of their brands. Although something like Hershey has been struggling, but other kind of brands like PepsiCo's, chips and many others, they've been growing amazingly well internationally, which has been pretty astonishing. And expected EPS growth will no longer be 10 and 15%, but it's closer to 7 to 8%, which is not bad at all. So you're getting a 7 to 8% EPS growth every single year on average, and maybe they can beat it if we have higher inflation. And you're also getting around a 3% dividend, and you're also getting a potential multiple expansion from 21.5 times earnings to 24 times earnings. To me, I see around a 10 or 11% annual return on Pepsi. This is not going to make you rich or anything crazy, but it's a pretty good return for most dividend investors. Most dividend investors, they look for a stable yield that's growing dividend and trading below fair value. I think Pepsi is fairly valued to undervalued, and I think it's one of, a pretty decent undervalued stock, dividend stock here in the market. Now here comes the second stock that I'm gonna talk about on YouTube. I've never talked about it before, and we'll see what you guys say in the comments. And this company is called DEV, called Decisive Dividends Corporation, or Decisive, or I say Decisive. So Decisive Dividends is sitting at $8 Canadian per share. They do have an OTC listing for US investors, but I am a US investor and I still buy the Canadian ticker if I want to buy it or if I want to sell it, because it's much more liquid and it's much higher volumes than the OTC one, even though the Canadian one is a little bit illiquid too, but it's still more liquid than the other one. I mean, this is what I like. I like these illiquid stocks, and I have other stocks. I mean, they barely even trade, but I don't mind illiquidity because it tends to provide an opportunity. I'm going to share it a little bit at the end of the video. I'm going to tell you a trick about Canadian stocks that most people don't actually know. But DE is sitting at $8 Canadian per share. This is a company that is called a serial acquirer, and they do a lot of acquisitions. They basically own a few companies in different industries. They take the free cash flow, they reinvest it into more companies, and then they take the free cash flow and reinvest. Just keep acquiring companies and companies and companies. Maybe like Berkshire Hathaway, or maybe something like the insurance company that's like Berkshire Hathaway. But it's like a serial acquirer. So or like Constellation Software. They just take the money, reinvest it, takes the free cash flow, reinvest it for more free cash flow. And in terms of Decisive Dividends, they focus on getting the free cash flow to grow the dividend and keep paying dividends over the long term. And they are internationally diversified in many different boring industries that you don't want to be in. Something like wood and gas stoves. They are still in demand, but this is a pretty niche market that they are in. And machines, in parts, agriculture, industrial, merchandising, and in many other things. This is their latest acquisition. The latest acquisition is something within agriculture. They manufacture certain parts for agricultural equipments. I mean, it's something, a very niche kind of markets. This is an amazing management team, and they acquired it for only 5.1 times EBITDA. And this is what I'm going to talk about in the video. This is why I have around 4 or 5 microcap stocks that are mainly serial acquirers. They just take the money and they reinvest it, and they just buy more companies. And the main reason I'm so heavily invested in this area of the market is because a lot of older people are retiring, or maybe they are passing away, unfortunately. And a lot of the new generation, they just don't want to run a wood or gas stove business. I mean, that's boring, right? They want to go on Instagram. They want to do a lot of crazy things. They don't want to, run an agricultural company. They don't want to run something like they manufacture some kind of boring parts or manufactures windows or whatever. They don't want to do that stuff. They want something a little bit more exciting. So a lot of these people are selling the business for cheap because they don't want to run it. And this is what's been happening. And a lot of companies like Decisive Dividends is acquiring these companies for 3 times EBITDA, 4 or 5 times EBITDA. Many other Canadian companies I own, one of them is in Canada, more of a housing construction company. A lot of people, they don't want to run a wood manufacturing company, small business. They acquire them for 2 times EBITDA and 3 times EBITDA. And this is going to boom over the long term because a lot of these people are retiring. They're selling the business for cheap. So this is why I'm heavily invested in this sector. And the best part about Decisive Dividends is because they are internationally diversified. So the TAM is pretty much unlimited. They can acquire companies for forever, which is pretty amazing. The company, something very important you have to focus on whenever you're looking for a micro cap or you're looking for a serial acquirer, is the management should have skin in the game. In the case of Decisive Dividends, the management insider ownership, they own 10.2% of the company, which is pretty decent. 10% ownership, that means they have skin in the game. That means their own interests are aligned with our own interests if we are shareholders of Decisive Dividends. And this is something you have to look for. And this company does have over 10% insider ownership, which what I tend to look for. In terms of the dividend, they have been massively growing the dividend. From 2016, it was 46 cents per share. Now it's at $2.51 per share. So a lot of dividend investors will love it because you can see the growth. The growth has been massive, massive. And you might believe that because the growth is so fast, that means the yield has to be 1 to 2%. It's not even close. The yield is 5.8%. So you're getting a 5.8% dividend yield plus a dividend that's growing around something like 55% and 62% in 2022, 64% growth in 2021. This is the beauty about it. So you have a fast-growing business, 5.8% dividend, and the dividend is growing around 60% a year. And the biggest drawdown with this whole thing, you might say, yeah, that's amazing, and everything looks amazing, I want to go buy the company. But what's the biggest risk? The biggest risk, and this is something that I don't like with this company, is they have massive share dilution. You could look at the shares outstanding. They have been going up like crazy. And this is something I don't like with companies. But this company is basically issuing stock and then using some cash and some debt to acquire other companies. Now, it might sound like a very bad saying and a very dumb saying. I mean, why would they pay the dividend and then issue shares to buy other companies and then issue shares to pay the dividend? It just doesn't make sense. But, I mean, you could see the stock price over the last year or so. And this business works, and this model works for them. And it does work for many other companies. And one way we can check if it's actually working or not is by checking per share metrics, EPS per share, free cash flow per share. Because if you look at general numbers like total free cash flow is going to be up way high because they're issuing shares. But you have to look at value per share, book value per share, free cash flow per share, dividend per share. Now, for example, free cash flow per share over the last 9 months is up 46% from 2022. If you like to look at profit or whatever they call it, EPS per share for Canada, EPS per share is up 30% for the 9 months compared to 2022. 30% and 46% free cash flow growth. Pretty amazing stuff. Now, which tell me is that yes, the company is issuing shares, but it's creating more value per share than it's actually diluting. And so this is why I'm pretty bullish on this company. Yes, I don't like the model. I don't like that they issue shares to pay for acquisitions and then they're paying the dividends. They could just use the cash and acquire without the dividend. And it makes me sad. But this is what this company does. It's called Decisive Dividends. They pay the dividends. Their goal is to get the companies, get the high free cash flow, then reinvest it in other companies and increase the dividend as the free cash flow increases. The management is very disciplined. They don't have an earnings call you can listen to, but you can go on the internet and type Decisive Dividends investor or CEO interview or whatever, and you could watch many interviews with the CEO. He's a pretty sharp person. Now, I showed you all these things. I showed you the company, how it's been massively growing, and I showed you their acquisitions that they did before, and I showed you that the company is international. Now, you might say this is a very large company. They own all these kind of different businesses. It must be like $1 billion or $2 billion company. Well, it's nowhere close to that. This company is still 150 million Canadian market cap. US market cap is 105 million. Trading at a 10% free cash flow yield. 60% of the free cash flow is paid as a dividend and 40% is used for acquisition. So you're having around 46% free cash flow growth per share. 10% free cash flow yield, which is very cheap for this company, 5.8% growing dividends, that's growing like 40 and 50% every single year. With a company that's international, it has unlimited TAM, sitting at 151 million market cap. This is why I believe this company has massive potential. I mean, I do not see why, if they keep on acquiring these companies, why it cannot be $1.5 billion market cap or a $2 billion conglomerate kind of market cap, even a $5 billion market cap 20 or 30 years from now. If they can keep repeating what they did over the last few years, I don't see why this company cannot keep growing. As they have been growing free cash flow 46% per share, 46%. Now, even if they grow 20 and 25%, I'm still satisfied. If they grow 15%, I'm satisfied. But for them growing 46%, that gives me a lot of margin of safety. If I want to run some numbers, 15, 20%, I mean, that would get me a double every 5 years. but it would likely be much more than a double every 5 years if they can keep up the 46%, free cash flow per share growth. So this is pretty amazing, and it's only 151 million Canadian. This is why I can talk about this one. The other microcaps I own are below $50 million Canadian market cap. And something that most of you don't know, and it's not well talked about, but most funds in Canada, they can't really buy stocks below $50 million. This is why if you look at a lot of the stocks in Canada, once they cross 50 million, they get $55 million or 55 million Canadian, especially Canadian. This is when a lot of funds, they are eligible to buy it, and then you see massive moves in the companies. So this is why I own a lot of stocks below $50 million Canadian market cap. If you're interested in finding out, you could join my group if you're interested in learning more about the other Canadian and serial acquirers that I own. But this was my thesis on Decisive dividends. I hope you do your research. This is a small company. It could go to zero. A lot of things can go wrong. It's mainly a bet on the management team's skills and abilities to pay the right price and keep finding acquisitions. And this is, of course, very, very risky. And I recommend you to size it accordingly if you're interested in it. Don't make it like you're buying Apple. I always tell people in my own group, we buy 5 or 6 microcaps. We make them small percentages. If we're right and the stock goes up 20 or 30 times, then we make a lot of money. But if it goes to zero, we don't lose too much. So this is the trick with microcaps, is owning a lot of them and making them a small enough percentage of your portfolio where you have an asymmetrical kind of return. And this was my thesis on Pepsi and DEV stock on the TSX Ventures Exchange. It was not financial advice, of course. Thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.